Welcome to the YUSA Pension Seminar. This is the second set of seminars that I just want to say the feedback we had from the first seminar was really positive, so I think you're all going to enjoy this. I'm Sunny Day, I'm president of YUSA, and I want to introduce Frank here. So he's the vice president of Page and Associates. He's a certified financial planner. He's done work with YUSA for many, many years. He helps the union manage our assets, and he's also very familiar with the York pension plan. So he's also a York alumni. He has his MBA from Schulich. So I'll turn it over to Frank. Thanks.
Today, despite the snow, I can't believe we've got snow on April the 11th. We first ran this seminar a few years back, and there's continued interest from people in the union about how the pension plan works and what the options might be upon retirement, and how would you integrate that pension plan benefit into your overall retirement plan. I know there are other seminars offered by the pension office, which are great and informative. Our focus today is going to be on how to provide for retirement needs using the various building blocks available, including government pensions and the York pension plan. Just think for a moment about the stereotypical life cycle, right? 100 young people graduate from high school, 20 years old-ish, and by age 65, they all want to probably be comfortably retired. But what really happens is there's the 1% that are rich, and then there's the other 99%. Out of that other 99%, if you look at how many people in the population control a majority of the wealth, we all know that few people control a lot of wealth. So let's just say the top 5% are very well off, right? No worries. 40% of those 100 graduates will be retired by age 65. At various different degrees of getting by, comfortably or maybe not quite so comfortably. 30 are still working, either because they want something to do or because they don't have enough income sources to live the kind of life they want without working. 10 are dependent on others at 65, often a disability, inability to work, and 15 have died before age 65. So you have a benefit plan here and a pension plan that helps with a few of these things. It's got life insurance, it's got disability income benefits, and you have a pension plan to help you with your retirement income so that you're not dependent on others by the time you're age 65. Your collective agreement provides for descriptions of what you're entitled to in terms of salary and vacation and sick days, and there's an insured benefits booklet that you can get that describes how your medical and dental and long-term disability benefits work. And there's also a pension booklet that you can get that describes how your pension plan works. But I'm going to tell you, hopefully in an easy to understand 40-minute seminar, how that pension plan works and what choices you'll have to make with it. Our firm, first of all, as Sunny mentioned, Page and Associates has been working with the union for many, many years. We're now in the third generation of people in this company. We've been doing financial planning work since 1982. We help people with insurance and pensions and investments and RRSPs and tax planning and all kinds of things like that. We've been working with YUSA for many, many years, over 20 years. YUSA, about in 2010, began to offer a financial planning consultation service for those approaching retirement who were struggling with decisions about the pension plan and for whom the answers from the pension office were not helping them make the decision. So if you'd like access to that service, contact the YUSA office and ask them about that. Today, let's talk about how we would figure out what you need. What are your needs in retirement likely to be? What are the different sources of income you could use to fill those needs? We'll talk about government benefits, Canada Pension, Old Age Security. We'll talk about the York University Pension Plan, how it works, how it's funded. We'll talk about if you still don't have enough resources between those three things, what else could you do in terms of saving? And then talk about how you might figure out your needs and then select a pension option when you're at the end of your working career. What are the choices with the actual pension and how might that now fit various need scenarios? Okay. If you think about the stereotypical work after high school and retire at age 65, you might expect that by 25, somebody who's maybe gone to university for a few years and is now starting out in a new career has a certain level of income. But as they gain experience those first 5 or 10 years, they're going to move up in the salary band. And they may prove that they've got the capability to do a higher level job and get a new position with an increase. So we often see incomes increase quite rapidly in the early stages of someone's career. But then as you mature in your career, unless you're getting promoted to progressively higher levels of responsibility and stress, you're probably going to get an annual raise that's about in line with inflation, right? And then at 65, the question is, how much of that income that I've now lost because I'm not working anymore, how much of that income am I actually going to need? Most people can get by on 60 to 80% of what they made while they were working. Why? Because hopefully if they have a mortgage, that's paid off by now. If they've been saving toward retirement, they don't have to save anymore because now they're drawing out, right? So those two things alone can reduce the needs quite a bit. Some people take the 407 to work. They have to pay for parking. You're making pension contributions, long-term disability premiums through your employer, right? So all those things go away, may go away at retirement. Now, some people invent other things to take the income up, right? They'll play more golf or take more vacations, and so you might save a little and you might need a little more. Everybody's got to think through that, how much is enough question for themselves. One way to do it is to use an expense budget. And most people don't like to do budgets. But if you have the stomach for it, you can download your credit card transaction data and your bank transaction data, put it in a spreadsheet, map it out for 3 months in a row, let's say, and just categorize those expenses and see what you're spending your money on, and then ask which of those do I need to continue in retirement and which can I do without. This method suffers from a few drawbacks, though. Bottom up, you're looking at lots of little data points, and you may have expenses that aren't so regular that you forget about, like saving for that annual vacation, or maybe your car insurance is due in August and you did the analysis in the spring and you forgot about it, right? So you have a tendency to underestimate your true costs if you use this method. Plus it's tedious and painful and most people don't like it. An easier way might be to say, what's my cash flow now? What do I take home from the university every month? And take that and subtract from that how much I'm saving, right? So if I'm taking home $4,000 a month and I'm saving $500 a month in an RSP, let's say, by definition, I'm spending the rest. So I need $3,500 to live the way I'm living today. And then all you need to do is say, what costs do I have today that I probably won't have anymore then? Maybe my 407 bill is $200 a month, and I know I'm not going to have that bill anymore when I don't come here every day. I'm going to save the parking, right? And just subtract a couple of items from this, and that gives you your number. That's how much I need every month to live comfortably. So I'm going to give you an example now. I'm going to use a couple, okay? Judy and Bob. It doesn't matter. Single people, only look at the left side. And spouses, in the pension plan definition, can be same-sex couples. They can be common law couples, okay? So if you have a partner that you've been with for 3 years, that partner could qualify as your spouse for tax purposes and the pension. But let's just use this as an example. Judy works at York, has a salary of $60,000. After all the deductions, she takes home $45,000 a year. Bob doesn't work at York. He makes $40,000. After all his taxes and deductions, he's taking home $33,000 a year. So if we add that up, we get $78,000. And now they tell me, well, last year we saved $12,000 in our RSP toward retirement. Okay, so that's money you didn't need to spend. And last year we also paid $12,000 on our mortgage, but it's going to be paid off next year. And then we're going to retire a couple of years after that. So I know that doesn't need to continue. So by that definition, they need about $54,000 a month. Okay, sorry, a year. And they may take off some expenses that won't continue, other ones, and they may add ones back for lifestyle enjoyment and other projects that they may have. But I'm aiming to get $4,500 a month or $54,000 net after tax for these people. Now, government benefits will plug some of the gap. Old age security is a government-run pension plan. It's been around since 1952 in about the same form it is now. It's available to everyone who's been a Canadian resident for 10 years or more. If you've been here 40 years as a resident, by the time you're 65, you'll get the full amount, which is about $600 a month. If you've been here less than 40 years, they'll prorate that number downward a little bit. And every quarter, they'll look at the Consumer Price Index, which is a measure of inflation, the rising cost of living, published by Statistics Canada, and the OAS people will apply a factor to increase that pension every quarter in line with increases in the Consumer Price Index, so that you don't find your expenses are going up and your income's not. The Canada pension plan is a little bit different. You also can get a monthly pension here from age 65 as the standard start date. But with CPP, you can choose to take it earlier. You can choose to take it as early as 60. You'll get a reduction then. Or you can defer it and take it as late as 70 if you don't need the income yet. And you'll get an increase then by waiting. I'll show you more about that in a moment. But the way this plan works is you only get out from it based on what you contributed to it. So there's this number. You'll see this in a lot of pension documents, YMPE, or years maximum pensionable earnings. This is a number that was originally defined for the CPP, and it's supposed to represent the income of a person with the average industrial wage. Okay? So let's go up to the average wage, and we're going to try to pay you a pension equal to 25% of that number. And that YMPE number is also inflated each year in line with the rising cost of living. So hopefully that YMPE number still bears a reasonable relationship to if you had that income, you'd probably be able to live okay. Right? Now that YMPE number is 57,400 for this year. But the way CPP works is they calculate a 5-year average of that number and then give you 25% of that, the last 5-year average. So right now, if you had contributed the maximum since you were age 18, which means that your income way long ago was lower because YMPE was lower, right? You didn't need as much to contribute the max. But if you contributed the max all the way through, you'd now get $11.54 a month if you retired now at age 65. So $600, $1,100, if you get the max on both of these, you got $1,750 a month before tax already, before your pension or any retirement savings. Now, as I mentioned, the YMPE increases every year with inflation, and these are the levels it's been at since 1966. We had heavy inflation in the mid-1980s, and then more tame inflation lately. Don't know where it will go, but right now that's where the YMPE has gotten. If you take your CPP at age 65, the max is the $11.54 a month. If you choose to take it early, they give you a little less. It makes sense, right? Because if at 65 you might have lived to be 80, that's 15 years of payments, and now you choose to take it from 60, that's 20 years worth of payments. So they'd have to pay you a little bit less to balance it out, right? To be fair. So the way it works is every year you take it earlier than 65, you suffer a 7.2% reduction. It's actually 0.6% per month. So every month you wait after 60, that reduction goes down and you could get the max. Similarly, if you defer it, if you take it later than 65, you get a 0.7% per month increase, or about 8% a year to defer it. So I talked to some people who are 67 and still working, and they have an income. They don't need the CPP yet. And if they expect to live a long time, they may want to take it later and have more. Where does this money come from? With old age security, that $600 a month per pensioner comes out of general tax revenue. There's no fund that secures that. It's a decision by the government to continue the program and to continue to tax workers enough to pay for the program. And by some measure, this program is going to be costing about 2.5% of GDP by the time we get to 2050. And so a previous government had tried to defer the start age for old age security to age 67 to save a few bucks. And the current government has brought it back to 65. So right now it's 65, but the rules could change. And there's no fund there to secure it. It's at the whim of our elected officials. But I can tell you this, every time they change it, there are many lobby groups that challenge them and make a fuss about it. So there is public outcry every time they try to water this down. The CPP, though, is quite different. Because it's funded by contributions, there's an actual fund, which is now billions of dollars. Okay, $356 billion of our money is invested in this thing from the people who've contributed over the years. And you're paying right now 4.95% of your earnings up to that YMPE number, and your employer is matching that. And that money goes to the CPP investment board, and they invest it. Now, they had some trouble back in the 90s. People were living longer, pensions had to be paid longer, right? Investment returns were declining. The thing was not projected to be around anymore by now. And so they decided to up the contribution rates from 1.8% up to the 4.95% over a period of years ending in 2003. And that's where it stayed. And it's on solid footing now. If I only had CPP and OAS, I didn't have any York pension, I had no savings of my own, that $1,750 a month I could get between CPP and the maximum OAS, that would apply if my income was at the YMPE, and I'd actually contributed up to that level, right? If my income was only half of the YMPE, I would have only contributed half to CPP, and I would only get half the pension. You can call them or go online and get a quote of what your own CPP will be at age 65 and at age 60 if you're younger, based on your actual history of earnings. So you can be more certain about what your number will be. But if I made only 20,000, I'm getting some CPP, but I'm still getting the full OAS, and those two together will replace 55% of what my income was when I was working. And when I was working, I paid tax on that income, right? And when I'm retired, most of that will be tax-free because of certain exemptions you get when you're over 65. So that's a very high replacement ratio already for somebody at that income level. The problem is that as income goes up, old age security doesn't go up. It stays at 600. The CPP will get higher, and by the time you get to the year's maximum pensionable earnings of about 55,000, you'd be somewhere between 38 and 32% of your income being replaced. That's quite a bit lower than 60 to 80 that most people would be comfortable with in retirement, right? And of course, the higher your income goes, the government benefits aren't getting any bigger, so the replacement percentage just gets worse as your income goes up. So you've got to do something else. Fortunately, you've got a pension plan that can help. But let's look at our couple again. If they both get the maximum old age security and they get CPP in line with the incomes we had on the prior slide, then these are their total gross incomes in retirement. They get the basic tax exemption, they get the age 65 exemption, and if they pay, they're in a 20% tax bracket for the rest, they've got 38,000 after-tax income already between the two of them. And so we need another 15,000 to hit our 54,000 goal, right? Where are we going to get it from? York University Pension Plan. Back in 2013, it just missed making the largest 100 pension funds in Canada. This is a big pension plan. At the time, it had about 8,000 members, 2,000 retired and 4,500 active across all the groups at York, who all have the same pension plan. At the time, there was about $1.6 billion in pension assets, but I believe recently it's now $2.65 billion, thereabouts. The benefit design is the same for everyone, regardless of your job here at the university. But the benefit amounts will vary with your income, just like CPP does. How do we do it? There are two different kinds of pension plan in Canada. One's called a defined benefit plan, where you know how much you're going to get at retirement. And the other one's called a defined contribution plan, where you don't know how much you're going to get, you just know how much you're putting in. And then it gets invested, and depending on how it does, that determines on what you get at the end. Your pension plan has a really unique design. You have the better of those two calculations. So they do provide you a minimum guarantee, but they also track what happened with your money and with the investment return of the fund, and if that would be better for you, you get extra. If it's worse, you still get that minimum guarantee. It's a great, great pension design. And the guaranteed part is that at age 65, you'll get a pension for life, as long as you live, which will be equal to 1.4% of your income up to the limit of the YMPE. Times that by how many years you've worked and been a member of the pension plan, a contributor. If you started at 25 here and didn't join the pension plan till 30, they would only credit you from the time you joined the plan. And because you don't get CPP on your income that's in excess of the YMPE, this pension plan is designed to pay a larger percentage of income for any part of your income that was above that level. So if you worked here for 30 years and you get an extra 0.5% of that piece of income, that would be 15%. CPP normally provides 25. Well, at least you get 15 extra from that slice of the pension plan. Okay? How might that look? If I've got this many years of credited service, then these are going to be the percentages of those two income slices that I'll have. So if I've been here for 20 years, times 1.4%, I get about 28% of my YMPE income, and I would get something like 10% then of the income that was in excess of that. There's after you've been here a certain number of years, and especially when you're over 65, the improvement in your pension benefits for every additional year of work might not be quite as large because there are certain limits in the pension plan. Let's look at an example. Average earnings, just like CPP, CPP takes the last 5 years of that YMPE number and averages it and bases the pension on that. Here at York, it's better than that. It's 5-year average, but it's the 5 best years you've ever had, and they don't need to be consecutive. And it's designed to help people who might have advanced to a senior position that's high income and high stress, and then they say, I don't want the hassles anymore. My last few years, I'm going to take a step back and take a lower level role, but they might not be willing to do it because that would bring their income down, and therefore their pension would reduce, right? Not so with this. If your income drops, they still count the best 5 years. Okay, separate calculations for the YMPE portion, that 1.4% times years of service times the income up to YMPE, and another calculation for the excess, because the excess might not always be in the same years as the best YMPE. So all these formulas have been negotiated and designed over the years to just give a lot of advantages to the pensioner. It's actually pretty good. This is an average of, or an example of how this best 5-year average might work. So if the blue bars are the income, the blue dark line is the average of the best 5 years. And even though the income took a drop in 2009, the average held steady because it was based on the best. And then once we get to 2012, the income was a little higher than the average. And so now they would put that year in and take out the year that was below it to get a better best 5 average. If I now take the same numbers and I apply separate calculations to the YMPE portion and the excess portion, you can see that the biggest excesses were while the salary was high. And then after the salary dropped, you're close to YMPE, so your excess is much smaller. So the calculation preserves the excess, the high average of excess prior to 2009, while still giving credit for the increasing YMPE. Good design. You also have a better deal if you decide to retire early. At CPP, it's aimed for 65, but you can retire as early as 60. With York, it's aimed at 65, but you could retire as early as 55. But similar to CPP, there's a penalty for retiring early for the same reason. The total number of years times that pension is going to be longer, so the same amount of money won't give as much for that much longer. But your penalty is better than CPP's. Your penalty is only 3% a year to go down to age 60, whereas the CPP penalty is 7.2. Your penalty, if you go from 60 down to 55, though, is 6%. Still better than the CPP penalty. So this is actually a pretty favorable adjustment factor for those wishing to retire before 65. So that's how the defined benefit works. What about the money purchase or the defined contribution or the one based on market values? How does that work? Well, they would take your contributions plus the contributions from York, matching yours, and they would, for each year that money is in the pension plan, they would add an interest factor, which is basically what was the return on the pension plan this year. And they'll credit you that much to this notional calculation. Your contributions are a little higher than CPP. CPP is 4.95% for you and the employer. This pension plan is 6.75% up to the YMPE. It used to be 4.5, but after 2008, there was a large decrease in the value of the pension fund, and its solvency was impaired, and for the same reasons as CPP had to raise their contribution rates in the 90s, this pension plan board decided to raise contributions here. After much discussion with members about whether they would prefer to pay a little more or give up some of the benefits that they had. And based on those discussions, it was deemed the better way to go to raise the contributions for a period of time. On the excess, because the benefit is higher, right? Up to YMPE, you get 1.4% per year of service. On the excess, you get 1.9. It must cost more. Yeah, it does. The contribution for that portion of your income is 9.15% of your salary for the portion above YMPE, and then the university matches that. Interest in the calculation is the return of the pension fund for each particular year, And then at the end of the line, when you're ready to retire, they'll look up some tables based on life expectancies for people your age at that time and say, using the total we've got in the bank here, in the pension fund, how big of an annuity could we buy you to guarantee that income for the rest of your life? And that's your number from this side of the calculation. If that number is higher than the minimum guarantee, you get the higher number. If it's lower, you still get the minimum guarantee. So what do they do with your money? You put your money into this pension fund. They actually have a pension board of trustees that has an investment policy statement that says, here's how we would invest this money prudently for the benefit of our members. They have decided with their investment counselors that they would have 50% of the fund in stocks from around the world and 30% in bonds from around the world, but 20% of them in Canada, and some real estate and some infrastructure. Infrastructure are things like power utilities and toll roads and things that produce income even in recessions. So this is a 70% equity portfolio. And how do they invest it? Well, they don't do it themselves. They've assigned various different investment managers like BlackRock and TD. You probably heard of both of those. You may not have heard of some of these other firms that are pension fund managers that work for other pension funds to manage billions of dollars of investment assets. And depending on how those folks do against certain benchmarks and criteria, they get replaced from time to time if they're not doing the job that the board expects them to do. Here's how they've done. These are the annual returns of the pension fund over the last 15 years. Last year was not such a great year, but you probably already know that, right? If you have any investments, you know that last year was not a great year at all. This is actually a pretty good return for a portfolio like this in a year like 2018. In 2008, of course, every investment fund pretty much went down. Stocks were down 40% plus. With a portfolio of 50% stocks, I would have expected a minus 20 that year. The blue line is the 5-year average. I put that on this graph because they use that 5-year average for a couple of different things in this pension plan. First thing is there's a 6% threshold. So the actuaries who designed the plan said, if we can get 6% a year return on this fund, everything's going to be good. Okay, so we want the 6%. But what if we do better? There'd be lots of choices. If we did better, we could drop your contribution rates back down to what they used to be. Or we could maybe offer some inflation protection, offer an increase to this pension every year that's guaranteed. Other options are available, but lots of things they could do. They've decided in the design of the plan the way it is now that if there's a return in excess of 6%, they're going to use that to give an inflationary increase to everybody who's already on a pension. But if they have less than 6%, there'll be no increase. And they actually also calculate a high watermark. I'm going to show you that in a minute, how that works. But you can notice here that the average, the 5-year average return was above 6% until 2008. With that big negative baked into the numbers, now the average dropped to something like 3%. And then it stayed under 6% all the way till 2013. So anybody who was on pension at that time did not get any inflationary increases, because the return of the fund didn't meet the threshold. And that's the design of the plan. Now, it went back above 6% more recently, and even after 2018, it's still at an average of 6%. So right now, people are getting an increase. How does it work? Sorry, I still have this labeled 4-year average. I wasn't able to get my chart to format right with the numbers, but I'll show you the graph of the 5-year version in a minute. They take the return, we get the average. It used to be 4 years before the revisions were made a few years ago to shore up the plan. And then they subtract the 6%, and then they say if your pension was 1,000, what would be the adjusted pension? Well, in that year, 2003, if the average were negative that year, right, your pension would drop by $4. But who wants that? Nobody wants a decrease, right? So they built in this protection that says it's a non-reduction benefit. So even if the formula says you would have a reduction, no, you still get your 1,000. And then they keep calculating these factors on last year's adjusted number until it comes above that non-reduction high water mark. And now your high water mark is 1,008. Now you get the 1,008. And then you can see the increases that were given. And then if you have a big decrease, again, it pulls the adjusted number below the 1103 you got last year, but you still get the 1103, and you would have continued to get the 1103 even though that average remained negative for all those years, until the adjusted number comes back above the 1103, and then increases will resume. So it's not a guaranteed index. You're sharing the risk with the pension fund manager of the return not being adequate to fund that inflationary increase. This is a graph of how that looks. The high water mark is what you had last, the highest, and even if the adjusted comes below, you still get that until the adjusted would have come up. In my same number example, using the 5-year average now, you would have resumed increases in 2050. So the pension plan did have a solvency problem. As I just mentioned, the contributions were increased. So the deficit in 2011 was almost 300 million. Don't worry, every big pension plan in the continent had a problem like this because of the investment returns and because people are living longer, and therefore the pension fund has to pay them for longer, right? So in 2012, by the time we got to 2012, it got a little better. The solvency ratio was up to 90%. That means 90% of all future benefits are funded by what we have. The deficit was down to 200 million, still a lot of money. So they decided to make the contribution increases, and now after 5 years of contribution increases, or 4 at the time, there was a surplus of 200 million. So some would argue, well, why don't we push the contributions back down to where they were then? If you're in surplus now, we don't need the money, the extra money anymore. And that's a discussion that your pension board of trustees are likely to have sometime. And there's probably a way for you to weigh in on that discussion, or know what's being considered and what's being proposed. They may prefer to wait a couple more years to see if we have another 2008, right? And maybe build a little more of a cushion before they decide to drop the contributions down, because it's painful to increase them. It's great to drop them, right? But nobody likes it when you increase them. Okay, but the benefits that you've earned to date, they're guaranteed. And there's money there to back it up. Don't worry. So remember Judy, our case study example? She was making $60,000 a year. Let's say she was at York for 20 years. Her minimum guaranteed pension is based on this formula. So 20 years times 1.4, 20 years times 1.9. Multiply that by the relative factors. She's going to have a pension of about $18,000. If I now look at what would happen with her pension included, but Bob still only has his CPP and OAS, she's got a 64% replacement ratio. He's got a little bit less. If I now put in their age exemptions, and with your York pension, it qualifies for an additional deduction called the pension income deduction, which gives you tax-free $2,000. And if these are spouses, common law, same sex, doesn't matter. If they're filing as spouses, Judy could split her pension with Bob, so Bob gets the $2,000 credit as well on his part of her pension. Anyway, even if they don't do that, their total net now, when you add it all up, comes to $52,000, and we wanted to get to 54. Can't do math. That should be a $1,500 gap per year. They're very close. They hardly need to save anything, right? But let's say they did need to save something. They could take some of their own money and put it in a registered retirement savings plan or a tax-free savings account. The RSP has a limit. It's in your tax forms what the limit is. Whatever you put in, you get to deduct at your current tax bracket. And then later on, take it out. Maybe you'll be in a lower bracket. That would be great. If you're not going to be in that position where you'll be in a lower bracket later, maybe the tax-free savings account is better for you. You don't get to deduct what you put in, but you never pay any tax on what you take out. So depending on your circumstances and goals, one type of account may have advantages over the other, but it depends on the individual circumstances. There's no hard rule. Yeah, we just kind of covered this, that the RSP would be better if you're going to be in a lower bracket, and those are some boundaries. Tax rates go up as you go into higher brackets. If you're earning about $40,000, you're paying 20% tax. On the income between 42-ish and $48,000, you're paying 25% tax. If you're 48 to 69 or 70, 69,000, you're at about 30% tax. So if you can deduct in the 30% bracket now and pay the tax 2 years from now in the 20% bracket, you've made a free 10% on the difference in tax rates. That's the attraction of the RSP. You would get the same benefit using York University's pension plan additional voluntary contributions. It's taxed like an RSP. You get the deduction for putting the money in, you get taxed on what comes out, and they'll factor it into both your money purchase calculation. Sorry, it'll only be in the money purchase calculation. It'll get added to the better of the money purchase and guaranteed pension calculation. If you wanted to save and provide for additional income, just an example, if you had $100,000 saved, let's say you have 10 years to go to retirement and you can afford $5,000 a year, put 10,000 in, get your tax refund, right? And you'd have some earnings too. We could help you figure that out, what you need to save to make a certain amount of income. But as an example, 100,000 at age 65, even if the person lived beyond life expectancy and we planned for age 90, let's say, life expectancy would be about 82, 83. So even if we planned for a longer than average life and we earned 5% and paid out every year $7,200, this works out to, that structure would sustain itself until age 90. You could do your own calculations on what your income gap is that you need and how much capital you'd need to save to replace that income for a period of time. If you want to know what your own York pension will give you, you can log into the pension plan website, and it knows your employment history, it knows your earnings history, it knows the contributions you've made to the pension plan, and it will assume that you continue to earn your current salary until whatever retirement date you select, and then it will tell you this is the guaranteed pension you would have by that point, and this is what we think your money purchase pension would be. And it'll show you what your additional voluntary contributions would do for you as well. What are your choices? Let's look at it a little bit. If I am single, I would get a pension for the rest of my life. But by definition, that means if I died in 5 years, the pension stops. And if you thought about it, if you had to do this yourself and you were planning to pay yourself a pension until you were 85, let's say, from 65, you'd have to plan to pay for 20 years. And if this person died after only 5 years and their pension ends, what happened with all the rest of the money? Well, it stays in the fund, and it pays the pensions to the people who live longer than age 85. Because if 85 is an average, then by definition, half the people die sooner and half the people live longer. So I have to fund the people who live to 104 as well, right? How do I do that? If I planned on everybody living to 104, I could pay out way less money. And I'd have all these extras. What would I do with it? So the actuaries and insurance companies that help work how these pension plans are supposed to operate, they figure out how many people are expected to die in every given year and how much can I pay the people who would die early so that I still have enough to pay the people who live longer. And it balances out. So you're sharing the risk with all the other members of the pension fund. Now, if you're selfish, and you have every right to be, it's human nature, you may not like that. You may say, I don't want to leave my money in the fund to help some of these people who are going to live to 104. I'd want my brother to get it. Right? Then you could say, okay, I'll have a pension for my lifetime, but guarantee me at least 10 years of that pension. So if I died after only 1 year, then my brother would get the other 9 years worth. Okay? Or if I wanted to have a longer guarantee, I could guarantee it for 15 years. Right? That would be okay too. But if everybody who died at 2 years, the rest of their money for 10 years got paid to somebody, then there's less left for the people who got to 104, right? So it wouldn't be fair to pay out the same amount to the person who chose that guarantee. So there's a reduction. You get less when you choose one of these guarantees. If I'm defined as having a spouse, if I've told the pension fund I have a spouse or common law partner at the time of my retirement, then I must choose a joint life pension to protect that spouse, because they may be depending on this income even if I should die early. You must, unless the spouse waives their right to it. Okay? The Pension Benefit Standards Act defines rights for spouses, and one of the rights is you're entitled to have a survivor benefit from your spouse's pension if they die before you. But you can waive it and then go back to the single, which has a higher payout. Right. After the second death, after the death of that spouse, there's no more. And if your spouse dies, Could you nominate another spouse? That's a good question. Don't have the answer at my fingertips right now. But there's lots of what ifs, right? Let's look at a live example. This is somebody who actually retired in the last couple of years. They had 35 years of service. Their final average best 5 years income was about $50,000. And at the time, the year's maximum pensionable earnings was 53. So this person didn't have any excesses, that 1.9% thing. If they looked at the contributions, the total contributions this person made to the pension plan was $233,000 with interest. And the university contributed just a little tiny bit more than that. This person also decided to make additional voluntary contributions at one point in the past, and they have grown to $4,000 with the interest on the pension fund. So one of the choices this person has is to bail, is to say, give me my $473,000. They could choose to do that, but there's a couple of consequences. First is it would all be taxable, and that's going to push you into like a 53% tax bracket. And you're not going to get the York University retiree medical benefits. You only get those if you take a pension from the pension plan. Instead of that, oh, and in some cases, those numbers end up being higher than what you're allowed to transfer to your own RSP to defer the tax. Usually you can transfer it to your own RSP, even if you don't have contribution room, and avoid the tax and then just draw from it yourself. That might be appropriate for somebody who's single and not well, has a limited life expectancy, doesn't want to get locked into a pension plan, would rather have the money and take out more for the few years they have left and then be able to leave the balance to their kids. Okay? But you lose the benefits. Or you just take the pension. And so in this particular case, the minimum guaranteed benefit based on the 35 years of service was $2,066 a month. But when they did the calculation based on the actual balance, they said, well, excluding the additional voluntary contributions, we've got $469,000. And with that money, we could actually buy a pension of $2,866 a month. It's $800 a month higher. So the way they do that is they take the higher of, and then they say the additional voluntary contributions of $4,000, that would buy you an additional $24 a month of lifetime pension. So in total, this person would get $2,890 a month. Now that's the standard calculation for this person. Yes? Yes. Mm-hmm. As long as they acknowledge and agree. I don't think those options are available here. It's either 50%, 60%, 75, or 100. And if you don't even want to give them 50, well, then just cut them out. Because yeah. And but yeah. Yeah, they do anything lower than 60. So it's odd. This pension plan was built and designed to pay a 50% survivor benefit. But the minimum required by the government is 60. So you're going to have to go to 60 or you need a spousal sign-off, but it's only funded to pay 50. So you'd get a slight reduction. Let me show you how it works. Okay. So in this particular case, what did we say? It was $2,891? $2,891, right? And if you look under joint 50%, it says $2,891. Because this person's got a spouse, and the pension plan was designed to pay 50% survivor benefit, that's the number that's on the previous page. But if the spouse says, no, honey, I want the full 60 I'm entitled to, then you've got to go take the 60, and now you're going to drop to $2,853 a month. So it costs you $40 extra a month to have that extra survivor benefit put on. And if you wanted to give the spouse 100% continuation, it's going to cost you another $150 a month off the starting pension to make sure that all of it continues after the death of the first pensioner. Right? Those are all choices you have. Now, if the spouse is independently wealthy and says, I don't need this, or I've seen cases where the pensioner is making an election and the spouse has terminal cancer. Why pay for a survivor benefit for a spouse whose life expectancy is much shorter than my own? So in that case, they said, waive it. I don't want the survivor benefit. Give the pensioner the single one of 3,100, and now you've gotten an increase of 120 bucks a month, or 210 more, right? So it depends on the circumstances. The choice you make is going to depend on your particular circumstances and who you have that's dependent on you, and how much protection you want to give them, right? So it's often a joint exercise between spouses or codependents to plan this all out. So in your own financial plan, start off by thinking about how much income you need. Look at the income you've got now, how you're spending it, what expenses you would need to carry on in retirement, and pick a target number. Do a cash flow projection. Go to the CPP folks, ask them how much CPP you should expect at 65. Figure out whether you'd get the maximum OAS pension. Go to York Pension and get an estimate from them. Put those numbers together and see if they get close to what you figure you're going to need. If you've got a gap, start saving. Put additional voluntary contributions in, or start making some RSP contributions. Do something. And then figure out what kind of account would be best. Is it a TFSA? Is it an RSP? If you can't use those, what other savings vehicles are available? And then plan to select an appropriate pension option. And if you need help with that, you can contact YUSA and ask them if you could have a consultation with somebody to help you. Yeah. Right. So the question was, can you use the additional voluntary contribution account like a home buyer's plan? No, it's part of the pension fund. You could transfer your additional voluntary contributions anytime to your own RSP and then take advantage of that, but there's an extra step. Those people leaving, if you don't mind, we did hand out some evaluation forms, and it would be great if we could get some feedback to learn how to make this better next time. Thank you.
Regarding the voluntary contributions, if when you're retiring just before, let's say you have other registered plans
Yep.
that you want to transfer in,
Yes.
and I think it's important because your pension looks at it like if it was going to make 6% or something like that, because that's the minimum.
Yep.
Could you explain more about that?
You can transfer your own RSP assets into additional voluntary contributions. They don't want you to do it all the time. Like, I think once a year is the limit if you do that. I'm not sure about the threshold 6%. In this calculation, they would assume that the pension fund continues to make the 6% in the future. If the return of the pension fund is lower, then the outcome number from the additional voluntary contributions will be correspondingly lower than what they're projecting here.
Yeah.
Does that help?
I was at a pension seminar a couple
Yeah.
weeks ago and I asked, so if I put in just before I retired,
Yeah.
let's say, for easy calculation,
Right.
$100,000.
Yeah.
They said it wouldn't be $106,000 in the account, but in the calculation of the pension,
Yeah.
they would treat it like that.
Okay, that's the details of that are, I don't know the answer to exactly that calculation. But I would be reluctant to put money into AVCs right before I retire. You could get a quote for what a pension would be for the money you've got, independent of this, right? You're putting an extra step in at a time when there's a lot of things going on and something could go wrong. If you like the AVC option, I would contribute as you go, or move your RSP into it a good while before retirement, right? Let it run. Sorry, you had a question?
No, I just want to know how long would be the consultation allowed? Like an hour, 2 hours?
Okay, I'll talk to you about that in a minute. There was another question up here? Yeah? So, sorry, your situation, you have a husband? Okay, that's might be good or bad. And you wanted to leave something to the kids after he dies too? Okay. Yeah, you're going to be single. Yeah. Yeah, you cut him out, take the single pension and put a 15-year guarantee on it. Right? And now when you die, the balance of those 15 years is going to go to your kids still, and he won't get any. Okay? All right. Sorry. He would need to sign off. Yeah, he does need to sign off. Yeah. Then the guarantee's gone. Nothing left. Right. Well, or you could give them some of what you're getting. You could give them along the way during the 15 years and watch them smile, right? Or pull the money out, put it in your own RSP, and take less and leave it longer. No, if you move it to an RSP, you don't get taxed until you take the income out. Medical benefits. Yes, if you pull it out and do it yourself, you're going to lose the medical benefits. You got to weigh, nothing's perfect, right, in life. You got to fit what you can into where it needs to go. Thank you very much.